today. That's what we're going to do. The Medtrans case. We're going to do Anthony case. And we're going to hopefully get a good chunk of Chapter 5 handout. So that's what we'll do today. I might split up the Chapter 5 handout and maybe do the Anthony case in between there. Just going through a handout, for an hour and a half or whatever is torture. So let's so let's see. Okay, so you should have a case called the Medtrans case. And I'll give you a couple minutes to go ahead and read through it. It's a very famous case, and I'll tell you why in a little bit. Well, actually, it tells why at the end of it, but it gets cited quite a bit now. It's sort of like a new rule when it came out, but now it's accepted. I gotta share something differently. Okay. Excuse me. All right, we'll kind of walk through this one. In this case, what it revolves around is there are standards that are for what they call professionals. Professionals are usually people who are licensed by the state to do something, and they're given a monopoly for this license, but they're also held up to a higher standard than other people. For instance, doctors, lawyers, therapists, CPAs, they're all in this category of law called professionals. And professionals have unlimited liability. They cannot incorporate and have liability. That's why they have malpractice insurance. If professionals could incorporate, they would just incorporate, and if someone sued them, they would just say, okay, my company goes bankrupt, you can come take the desk and open up another company, buy a new desk and start again. But because they're held up to a higher standard, they can't do that. They have unlimited liability. And also what goes with them is, higher standards that you owe to your clients, basically. And so you're giving them let's take a doctor as an example. Doctors can practice medicine. No one else can. Unless you have a doctor's license, can't practice medicine. They give you the license. However, with that license comes responsibilities. And, not only unlimited liability, but also responsibilities to your client, the patient, and to the public as in general. You're held up to a higher standard. I'll give you just an example. As a professional in Illinois, we have to report child abuse, elderly abuse, financial abuse, things like that. We have to report them, and they have to be reported immediately. Now, there's other people that have to be reporting too. There's teachers and stuff too. However, it's a higher standard than for other people, and you can actually get a license pulled for not reporting something. But the idea again being that you have a higher standard that you owe to the people. And one of the things is you owe your client is that you cannot leave them in a situation that's basically worse than they started. For example, if you're a doctor, you walk into a surgery, you think it's going to be a routine surgery, you open the patient up and you see there's all kinds of problems. You say, whoa, I didn't want this, and you run out of the room. You can't do that. As a doctor, you have that duty to do the best that you can for your patient, regardless of their condition, regardless of whether you planned on being that way or not. That you have to you're under that duty of care for your client, your patient. So that's the whole idea behind these, what they call professional rules. Those are different than the professional standards the AICPA makes. AICPA makes their own standards. These are actual laws that are governed by the states, but they apply to professionals, people who are licensed to do things. As CPAs, you're licensed to sign off on audit reports. No one else can do that. So you are given that license, but with that license comes the responsibility of these professional laws that are governed, and basically are rules you have to follow for every professional that is licensed by the states to do certain things. Okay, so so that is kind of what this is all about. So Deloitte says they'll do the audit. Medtrans gave an investor unaudited financial statement showing profits of $1.9 million for fiscal year 2009. They were looking to get $10 million in financing out of this. Okay, the CPA firm said, okay, you got some things wrong here. So here's the new financial statements that you make these adjustments because you actually had lost $500,000. And then here's an incredibly bad sign. their chief financial officer resigned, indicating that he could not sign the management letter. At the end of an audit, you give them a management letter saying, here's everything that you've told me that these things are all correct. And the CFO said, I can't sign a management letter, and left. Okay. Discuss some options, or you refused them all. And the firm then withdrew from the engagement. Medtrans retained 2 other CPA firms, ultimately a third successor. So this is the 4th CPA firm. Issued an unqualified report, which is a good report. This is old terminology. Today we call this unmodified. Report. This is the current term for it. Which contained the adjustments. So they gave him a clean report, but the Medtrans had made the adjustments. Medtrans alleged that the result of Deloitte 2's wrongful withdrawal from the engagement, the investor failed to complete the letter to lend the company $10 million. According to Medtrans, because they had lost the loan, it sold several months later for approximately $10 million less than its true value. Okay, so not a good client. Now at trial, according to California law, they could not, under any circumstances, withdraw from engagement if it unduly jeopardized the interest of the client. And Medtrans prevailed. Now, here is something in auditing that is different than many other professions. And that is that there's a time element to it. And that, what I mean by that is, if you are, yeah.
You cut off. Can you repeat that?
Oh, yeah. No, I feel wrong with my microphone.
You said there's a difference.
Yes, yeah. There's a difference between auditing and other professions, in that there is a time factor. In that, for instance, if their year end is December 31st, on December 31st is probably when you end up taking the inventory, or at least a good chunk of the inventory on December 31st. You're also going to do cutoffs on December 31st. Cutoffs as far as shipping and receiving merchandise, what they own, what they don't own, and all that kind of stuff, what was sold. Doing new cutoffs as far as bank deposits, that you may want to be there when they do those. Anyway, so December 31st, there's a lot of things going on that you need the auditors to be there for. If you quit the audit in, say, January, the next auditors coming in, they can't jump in the time machine and go back and do the inventory from 12/31. So it is, it does impose some things on a client that, even if they're a horrible client, withdrawing from an engagement can cause some real damage, because then you end up, now that you would certainly communicate with the auditors coming in. However, there is that time element to auditing that, especially if it's after the financial statement date, that you run into a problem. Now, if it's 3 months before the audit, they can probably find somebody else to come in. It's probably not that big of a deal. However, if it's during an audit, it's a real problem to withdraw. And the ACCPA will say, look at this, these people they lack integrity. You should not associate with them. If you associate with them, you're reducing the impact of the credibility of the financial report, and you're also hurting your other clients because you're associating with this person of ill repute. So you should withdraw from the audit. Now, we got to remember, what is the ACCPA? It's a club. So you're going to go into court and say, well, I know there's this, established law that goes back 200 years, but I belong to this club, and this club I belong to says, it didn't hold much water. This is the first case that they actually, and it did it on appeal, and I think just because it was such a miscarriage of justice, they said, no. You can look at the professional standards by any given profession. Those can be part of your basis for your decision in cases like this. And it was monumental. This is a case that's been used many, in many instances, this case has been brought up because it was the first time that professional standards by a professional organization were allowed in a courtroom to be reviewed for the case. And so that's kind of what this this down here, this is a very kind of an important part. And it basically said they reversed it. And I think most likely this was reversed because it was felt that this would be a miscarriage of justice if it was allowed to stand. That you have someone who basically caused this by their own doing, and then use the rule of the professional laws by the state to unjustly enrich themselves. So it was allowed that they could actually use the ACCT standards. And again, this has been widely cited in other cases after this, and that you have cases where clients sue somebody, and if it was basically for their own, based on their own actions, a lot of times these things happen, that you can have professional standards come in. But having said that, you still cannot just walk away from an audit, even if you end up with a client you're not, it's pretty difficult. Now, we got to remember too, though, what do we do as auditors? We only do one thing, really, and that is we give an opinion. It's in the audit report. We give an opinion on the financial statements. What should have they done? Delight and choose. What should they have probably done in this case rather than withdrawing from the audit?
Like besides finishing it?
No, actually, I think they probably should have finished it and done what? So we give them an opinion. So what we, probably would have been, anyone? So we're required to give an opinion. That's the only thing that we're required to do, actually. We do our audit. It is an opinion. It's not a statement of fact. It's an opinion. But we're required to give an opinion, which we've done.
So we probably would have just given them the worst opinion.
Yeah, worst opinion. There's two bad opinions. I don't know if we talk about types of opinions. I don't know if we did or not. But there's qualified opinions and adverse opinions, and give them one of those two. Hey, we completed the audit. That's what we're supposed to do. That's what you paid us to do. Here is the audit. Here's the audit opinion. We're giving you an adverse opinion or a qualified opinion. And right in that opinion, it will say what the financial statements are misstated by. So it'll say these financial statements are overstated by 2.4 million, I guess it is. Because they showed a profit of 1.9 when it really was a minus 500,000. So a better alternative than withdrawing often is just to finish the audit. Because if you leave them, especially if you do it after the end of the year, you really are putting them in a tough situation. Again, they might be complete jerks. I'm sure doctors run on the same thing. Someone's a complete jerk, but they still have to, do the operation due to their disability and all that kind of stuff. So even though the AICPA will say you immediately withdraw, you probably want to at least talk to a lawyer to see if that is really the best alternative. And a lot of times I would guess that the best alternative is just to give them a bad audit, give them a bad opinion, give them disclaimer, or not disclaimer, adverse opinion, and be done with it. And also, a lot of times, if the client realizes that they're going to get an adverse opinion, they change their tune. They'll be real tough and all that until you say, okay, well, you're getting an adverse opinion. And if they fire you, they fire you. That's on them. But you just tell them, like, you're getting an adverse opinion, and hopefully they see the light. And that's really what a big part of the auditing is that hopefully, adverse opinions and qualified opinions, things that are bad, they don't help the company. They hurt it, because anything that they have stated is going to be in that report. Is not going to be a secret. It's going to be right in the report, and there's going to be some demonstration of deception in putting out those financial statements. So going to a bank saying you have a loss of 500,000 is one thing. Going to the bank with financial statements that say you have a 1.9 million profit, and an audit report that says you have a loss shows that you're trying to be deceptive, and the bank probably wants nothing to do with that. Where they may give a loan if you're losing money, it's not that uncommon for companies to have losses, especially if they're growing or whatever. But so anyway, so hopefully just the threat of the opinion will make them see the light. Okay, let's go ahead and get into the, any questions on that? But it's a very famous case, because up until that time, professional standards were not allowed in, this club that I belong to says this, who cares? But since that case, professional standards can be admitted in some situations anyways. Okay. Nope, wrong one. Nope, wrong one. I don't have the right one up here. Oopsie daisy. So internal control. I think we're on page 5.
Hey, Professor.
Yeah.
Are we gonna? I'm sorry, I stepped away for a second. Are we gonna turn this this sheet we just filled out in?
That one you're not going to turn in. There's going to be another one for the Anthony video that you will turn in, and we'll get to that later on. Okay. But by the way, I'm slowly learning how to teach online. I know it's been a year. It takes some of us longer than others. But I think I know how I'm going to do it. I think I'm going to do it using the polls more, and hopefully this will get people more involved in it, more whatever. That you'll actually answer the 10 questions or 20 questions, whatever, through a handout, and that you'll put those in. Those polls will not be anonymous. I will be able to see them and see who answered what. And we'll go over what the correct answers were in them. But I think that would be, it's probably going to be a better way of doing it. Just in general, there's a electronic trail and all that kind of stuff. But anyway, yeah. So to answer your question, no, you don't need to turn in the Medtrans case. But there's going to be one case that you will have to turn in later on, the Anthony case. We should go over.
Okay, thank you.
You're welcome. Okay. Oh, we went further than I thought. Okay. I don't know if we covered this or not. I'm on page 5, number 4.
Yeah, we have to start on that number 4.
Number 4. Okay.
Yeah, start on number 4.
Okay, so we had, so this is if you're going to rely on the internal controls. It's only if you're going to rely on the internal controls. If you're not going to rely on the internal controls, Let me. So just if you're going to rely on it, and generally speaking, I don't want to put that in parentheses. I should put this in parentheses. So internal controls. The only reason why you test internal controls usually, well, I should say there's two reasons why you test. But the for doing the financial audit, the only reason is if you think you'll save money by reducing the substantive testing. So basically, you rely on the internal controls because you think it's more efficient to do the testing controls. If the testing controls are not more efficient, you probably aren't going to do them for a regular audit. So your reasons for relying on the internal controls is basically it's so you can reduce the substantive testing. There's some companies that the substantive testing would be absolutely prohibitively expensive. You know, doing substantive tests for the inventory of Walmart. Well, forget it. You know, you're going to have to rely on the controls at some point because there's no way you can get enough auditors to do enough testing of the substantive testing without relying on internal controls. So you only if you're going to rely on the internal controls, in other words, that they are in place, how they're working, how, you know, if they're correctly designed, if they're correctly being performed. You only want to rely on those if you reduce your substantive testing, the testing for the dollar amounts. If the controls are bad and you can't rely on them, there's no reason to test them. Small companies, and did I talk about this before? I can't remember. Small companies a lot of times don't have internal controls. We talk about segregation of duties where you need to segregate those 3 incompatible duties. If you only have 2 people in the place, forget it. You know, a major part of your internal control is gone. So a lot of times, you know, if it's a small company, you may not rely on them at all. It could also be, you know, a lot of times, you know, it is for an efficiency thing too. If a company only has, let's say it's a building company and they have 8 contracts, you say, okay, well, we could do the controls over the contracts, or we could just test each of those 8 contracts, right? I mean, you know, if there's only 8 contracts and they're probably all material, just test the contracts, forget about the controls. So you only do it for a financial audit, basically, is if it's going to be more efficient, if you're going to be able to reduce the cost or the time spent by doing it. And if you're not, you don't have to test the controls. You know, I used to give out an example of an internal control. Maybe I'll do that. I'll take a look here and see what I have. Okay, so you plan the test of controls if you're going to do them, and you perform the tests. So, and these are usually they're sampling for attributes, yes, no. Very similar to what we had up above in that questionnaire. So up here in the questionnaire, you know, are all employees paid by check or direct deposit? Yes or no? Well, you can test those. You can test the payments to employees and see which ones were paid by check or direct deposit. And if anyone was paid with something other than that, like cash or something like that, you'd make a note of it. So you'd be whoever was paid by check or direct deposit, yes. If someone was paid cash, no. So these are all could definitely be tests of internal controls that you'd have there. And by the way, sampling for dollar amounts is just one thing. What's the dollar amount? No, so if you sampled payments made to employees, what dollar amount did you pay them? I don't care whether they're paid by check or direct, deposit or cash, or paid them in bananas or whatever.
Bitcoin.
So it's just $1. Whereas test of controls, I've done test of controls that have had 35 things we test for. So, any transaction you can you have a bunch of different things. So testing the controls can be kind of expensive. But at the same time, it can definitely give you a good insight into not only whether things are misstated or not, but also where the problems could be. So if you find some problem with the internal controls, you can say, okay, when we do testing, we're going to test for this because apparently there's a problem with sales returns, because the sales returns were done, not very consistently or whatever it was. Okay, now we know where to, now we know where to do the substantive testing. We're going to test on these sales returns rather than just randomly going out and testing everything at the same amount. Okay, and so it's more involved, but it also gives you a lot more information. Test of controls do not tell you if the financial statements are misstated, materially misstated. It's important that they put a big capital letter there. Okay, so test controls will not tell you if the financial statements are materially misstated. So you're not going to do test controls and have it and say, okay, we have these financial statements are misstated by $80,000. It's not going to happen because you're not. These are yes/no tests. They're not dollar tests. Okay, and one of the big reasons why you do it is so that you can have more of this information to evaluate the control risk. In other words, you get a better idea of what could go wrong. So evaluate the control risk, and this is going to be purely based upon your based on results of the test controls. And the test controls can come in two flavors. Design deficiency, the control is designed incorrectly. Or the second one could be that it is people that are using the controls don't understand it. And so they're not using it correctly. Oops. So these are the two areas that that you run into: the design deficiency And the design deficiency is whether they designed it correctly in the first place, and then the operations of the deficiency. Those people that are using it may not understand how it's being used. Let me give you examples of each of these. I used to be an instructor at Robert Morris University, and in downtown Chicago. And on the 8th floor, we used to have a learning center. Later on, I got moved to the 2nd floor, but regardless. And it was on the 8th floor. And every day they would get 5, maybe 10 students into this learning center. And as instructors, we would have to go up there a couple times a week and help students with any problems they had. For I was in accounting, obviously. Okay, we had math people, and you get the idea. So on the 8th floor, they had this tutoring center. And they got 5 new computers were delivered for the tutoring center. They were delivered in the morning. I can't remember what day of the week it was, but in the morning, it was during the week. And this was back in the day when the monitors were, so these boxes of computers were giant and heavy. And then there's 5 of them. So they stacked them up in and the IT people were supposed to install them, and they were going to do it the next day. They come in the next day, all the computers, all 5 of them are gone. Okay, so they had figured, okay, these were probably stolen at night. Maybe not a bad thing, but not a bad conclusion. However, they said these must have been stolen by students. Did students steal the computers? This is downtown Chicago. There's 5 giant boxes that probably weigh 100 pounds each on the 8th floor. And 5 of them, all 5 of them are gone. Did students steal the computers?
Probably not.
No way. I mean, how would they do it? I mean, stealing one would have been a feat, but so you'd have to. First of all, you'd have to know the computers were there, and like I said, we had 5 to 10 students a day going up there, and most students were probably completely indifferent to what was there anyway. So you're looking at maybe 5 to 10 students that even have the chance of knowing that those computers were there. And then, even if they did know, how are they going to do it? One person going to the elevator 5 times, probably have to have a dolly or something, bringing it down, having to have a car waiting probably in the alley or something, or a truck. And you can't just hop on public transportation with 5 gigantic boxes. So it is completely absurd that this would have been students. And quite honestly, okay, well, who could it next be? Faculty, maybe, right? Faculty. Well, faculty are going to run into the same situation. Faculty did go up to the learning center, but you'd run into the same problem. There'd be a handful, probably 5 to 10 faculty at the most would have been up there, and they would have the same problem. Now, you could say, okay, maybe they got their friend. You can imagine, okay, that makes it even less likely if they start talking to other people. Hey, I'm going to steal a bunch of computers. You want to help me? Eventually, that's going to be bad news. Most people are going to say, no. And, so what likely happened to the computers? Who likely took the computers?
Wait, did the computers actually make it into the building?
They were on the 8th floor.
Oh, okay, so they did get delivered.
They get delivered, and it was noticed in the morning when the IT people came. They're like, well, where are the computers that we're supposed to put in? And that's literally how they, how it came about that someone had taken the computers. But they were on the 8th floor. So who do you
Then
think?
it couldn't have been the delivery guys. There's no way they bring them up and then bring them back down.
Yeah. Well, they could have. I mean, that would be a certainly a scenario that would be more likely than any other one. But it was probably some kind of an inside job. Somebody that had to know where the cameras were, had to know which elevators to use that they wouldn't show up on the cameras, had to know. It was, and had to have some kind of transportation waiting for these things so that they could take them. So it almost certainly had to be some kind of an inside job. That would just be the obvious thing. Now, she said, okay, well, what does it have to do with anything we're talking about? Their control over this, they said, okay, we don't want this to happen again, obviously. So their control was at night, they would lock the 8th floor so that faculty and students could not get into the 8th floor. Did that improve the controls or not?
Probably not.
Yeah. Now you've taken away the slim chance that a student or employee would walk in on somebody taking them, because now it's obviously some kind of an inside job. And now, because the doors are locked, those people that are the insiders, security or maintenance or whoever it was, those people now could do what they wanted to do without worrying about somebody accidentally, some dopey accounting professor accidentally walking into the office and seeing what they're doing. So it hurt the controls, and again, the premise that students took, it was just beyond absurd. And whenever we found things that were stolen, I'm not talking about like little things like someone's calculator or a textbook or something was disappeared, from the library or something like that. But anytime we ever found out when large things were taken, large screen TVs, computers, printers, all that kind of stuff, every single time it was employees. And you'll find that true in almost all businesses, that employees generally steal a lot more than, say, customers. Employees steal something like 6 times more than, say, shoplifters. So if you're working at Home Depot, employees are 6 times more likely to steal something than a shoplifter is. It's just, that's just why? Because they have the opportunity, whereas most customers don't. So anyway, that's a poorly designed control. It's a control that does exactly opposite. I think I told you this before. We also had an ordering system for ordering parts and stuff in one of the assembly plants in Springfield, Ohio, actually. That they had 7 to 9 people had to approve every order. Not one person, not 2 people, 7 to 9. And so you'd have these people, these managers that would come in, and they would literally have hundreds of things, and they weren't looking at any of them. They just approved everything. And I wrote that up as a control weakness, because the responsibility wasn't on anyone. If something was ordered, you had 9 people approving it, because you can't really point at one person and say, you were supposed to catch this. No, I wasn't. That's Amy should have caught that. Amy said, no, I should have done. Should have caught. So anyway, it's there are sometimes people think that things are really good controls, but actually they heard it. That's a design flaw in the controls. The other one I had, what was I talking about here? Operational deficiency. I may have already told you this boring story. Did I tell you about when I worked in a bicycle shop?
No.
No.
You guys, you should have said yes. I didn't tell the boring story. But anyway, when I was like 14, I started working in a bicycle shop, and me and 2 other 14-year-old kids were working in a bicycle shop. And back then, you could work when you were 14, and you didn't have to have a social security number. But anyway, so I was working in a bicycle shop when I was 14, and because we knew some about building bicycles and stuff like that, but we didn't, we weren't bus mechanics, so they would have us work the cash register. And so we had these old cash registers, and someone would buy something, we'd ring it up, and, hang up the tag, and then we hand them the receipt, and these things would always be all smeary, and they would, I can't really read this. Okay, well, let me ring you up on this other register. So I ring up the other register, and everyone else did the same thing. What's the problem? So I would ring it up on this register. It didn't print out very well. I go to the other register. Maybe that one didn't print out well or something, or it was out of tape. I go to the next register and ring it up. What's the problem?
Wouldn't it show they have sold more than of what you had because you're doing it at multiple registers?
That's exactly what happened. It looks like someone's stealing massive amounts of money out of the cash register, and that's exactly what they were. So, like after a couple of weeks, they call us and there's all kinds of money missing, and I was, we're like, oh, we're looking at each other, and I was just, this is even funnier. I think I made $1.35 an hour, but anyway, so they were all set, and then one of the owners, when I looked at it, said, how come these things are all being rung up 10 seconds apart on 3 different registers? Why is that? Oh, because that register doesn't work right all the time. And so anyway, long story short though, because the control of what's in the register cash wise should match what was rung up, because of that control was gone. People could have been taking money out of the cash register and you would have known. So that is a control weakness, simply because we didn't understand, being 14-year-old kids, it never occurred to us that what you rang up in the register was what had to be inside it. We just, it was completely foreign to us. So, and that was just employees that didn't know the controls. And again, someone could have been stealing money at that time because that control was really missing. So anyway, that's so a design one is one that is designed incorrectly. And operational deficiency, that's when you put 14-year-old kids in charge of cash registers and see what happens. Okay. I think I'm gonna stop here for now. I'll stop here and let's take a break, and I'll come back. Let's say like 7 o'clock. 7 o'clock, come back and we'll do the Anthony video. That'll kind of break this thing up a little bit. So be back at say 7. We'll still do some of this handout, but we'll break it up a little. Okay. All right. So yeah, be back at 7 p.m. and then we'll do. You can pull up the Anthony handout. Actually, I should pull that up. Nope. Nope. So pull this handout up if you would, and we'll go over this video. Okay, this is a case, it's a video that I recorded as my my brother-in-law Anthony, which it was actually one of the good guys, but he got uh, he was a very he was a very good business person. Went up and got tangled up with a bad group, and basically this is his story about what happened with fraud, where he was the company where he worked at. And he told us to graduate class. This is done at Robert Morris University. It was done. You can hear the L trains going by every now and then. It was recorded in the classroom. He talked for a really long time. He talked for over 2 hours, maybe close to 3 hours. This is cut down into, I think it's like 30 minutes or something like that. But yeah, it's very crudely cut down. It was, 20-year-old technology at the time. So you'll see the kind of jerky, editing and by me. But anyway, cut it down from about like 2.5 hours or so down to about 30 minutes. But he spoke about how this happens, and one of the things that is very strange about fraud is a lot of times the number of people involved. We all know that one person. We all have that cousin or something that But the idea is that a lot of frauds, it seems almost impossible that you get that many people doing bad things. And statistically, it's virtually impossible. I think the largest corporate fraud, I think investment fraud, the biggest one was Madoff, I think. But Parmalat is a company in, I think it's a Italian company originally, but it's a European company. And they had the largest corporate fraud, I think, in history. I think it's something like $8 to $12 billion, many times bigger than WorldCom or Enron. But they had 76 auditors were arrested. Not people inside the company doing the fraud. 76 auditors, external auditors, CPAs. They call them CAs over there, but CPAs that were arrested for fraud. And the question is, how do you get, especially in a CPA firm, how do you get 76 bad apples together? I mean, and here's why that's so crazy is, like I say, mathematically, it's virtually impossible. It's like it's sort of like this. Let's say that people are 10% inclined to do bad things, which is very high. So 10% of people are bad apple. That pen is a bad pen. Let's try it again. %10 of the people are bad apples. This probably made it look worse. But so if you have one person working on something, the probability of it going bad is 10%. Now, if you put another person in there, say, okay, now we have 2 people involved in the fraud, say, what are the odds of that happening? Now you're down to 1%. That's why a lot of times you'll have 2 people, say, in the mailroom opening up checks and things like that. And you get the idea. As you start adding more people, mathematically, you start ending up with you know, 0.1%. Okay, you do this up to 76 people, and even at the high bad apple rate of 10%, which is crazy high, it's mathematically impossible that could ever occur. You're talking about one in zillions or whatever. So we know that it does occur, and the question is, well, how does that happen? How does it happen that you have, 76 auditors plus hundreds of people inside the company get arrested for a fraud that went on for 10 years and was for $12 billion or whatever? How does that happen? How do you get 12? And the real answer is, it comes down to the kind of the makeup of the people who commit fraud. What are they like? People who commit fraud are unlike anyone else in say a prison population. People who go to jail for all kinds of stuff. People who commit fraud are way different than your average person that's locked up. They have almost no characteristics of the rest of the prison population. They're usually educated. They're usually smart. They're usually very, they generally want to please people. They're actually, they look like your best employees. That's who is like, they say, well, who's most likely to be, committing fraud in this place? Go find your best employee. That is most likely going to be, your person. And there's also another weird thing about it is the recidivism of crime. Other than maybe something like sex offenders, people who commit frauds get out, they commit fraud again. They get out, they commit fraud again. It's just, there's something about it that way also. So given those, kind of factors, the question is, well, so a lot of times the people who get caught up in these frauds are actually sort of overachievers. They're people who are, like I say, a lot of times your best employees will be the ones that will be, the ones that will commit it. The employee that drags in a half hour late and does, that's probably not going to be your person that commits a fraud. They may annoy you in another way, but they're not the ones that are going to be convinced. So anyway, so this is I think that this video did a pretty good job. I remember him and his family moved down to Texas, and they came back, and it was, they said, oh, these people were bad people, and he came up to me, he said, well, I'd like to talk to your class. All right, sure, and so that's when he came in and did this. So anyway, this is the video, and it really does, I think, kind of give a good feel exactly for how this kind of stuff happens. Let's see here. Give me 1 second. Okay, and I think this might be a little loud.
Sure. Part of the story. I was answering an ad in a newspaper after I graduated from college, and started off as low as you can start. They had probably 2,000 stores worldwide at that time, but just a few here in the U.S. They had just started. Started out as an assistant manager, became a manager, a district supervisor. They were growing fast. They needed young, energetic people, and ended up in their purchasing department, which was a great steady position, corporate level position. Didn't have to move around, and was responsible for negotiating. At the end of my 16 years there, it was over $1 billion.
Can you guys hear this?
A year, and I was one of many people there.
Yeah, we can hear it.
Okay.
Which has only grown since I left. But it was privately held, and that's the key to one of the things I wanted to talk about today. I had my whole corporate experience in a privately held company. One family owned it. It's a company that managed its expenses very wisely, never spent an extra penny on anything they shouldn't be spending a penny on, and they bought product correctly. You could negotiate in good faith with vendors. They knew that what you agreed to verbally was going to happen, and very importantly, at the end of the day, that their invoices were going to be paid on time. If you agreed to pay $1 for a bottle of vegetable oil, that's what you would get paid. You would always get paid on time. Aldi is a company that has operated that way and grown and been incredibly profitable doing that. The business model is very simple. Buy low, sell it at a fair price, hopefully lower than everybody else, and make your thin margin in the middle and grow off of that.
Decided that maybe you would leave there.
That's a very good question. One thing about Aldi is that they are so structured. There's a very clear corporate ladder that you climb. As an assistant manager of a store, you become a manager, then you become a district supervisor of 5 stores, and then you hit this director level. I had progressed through the first 3 up to the director level in about 5 years, which was about normal in those days as they were growing fast. Once I became a director of purchasing, I did that for 12 years, or 11 years, let's say. And the vice president that was over my department was the same age I was. There really wasn't much room for advancement for me at that point. So I could comfortably be a director for the rest of my life, always do the same thing I always did. You know, in my late 30s, thinking if I'm ever going to make a change, you know, that was the time. Got contacted out of the blue by a recruiter for Fleming, and they were serious. And the numbers they talked about were, you know, they asked me what it would take, is what it got down to. So I could negotiate a salary that was very comparable to what I had. And one thing that I had never experienced, I mean, they were a publicly traded company. They offered me these things called stock options. And that was an incentive as well. Fleming stock was trading at about $11 a share at that time, and had good prospects to go up. And you know, here I was, somebody that had worked in a publicly traded environment, very close knit, didn't talk to a lot of other retailers, and there was a real player out there, probably a Fortune 100 company at the time, billions of dollars in sales, easily 4 or 5 times the size of the company that Aldi was, and they were serious. They had the right package, and also something that I had never experienced was a bonus. You know, they would match his salary and offer a bonus. I was actually hired away to start a chain of stores very similar to Aldi. Originally, the purchasing office for this new chain of stores was going to be here in the Chicago area, so I got to stay here. When I originally negotiated it, it didn't involve a move. I knew it could happen, but they allowed me the freedom to set up the corporate buying office for this little chain of stores anywhere we wanted. And fortunately, one of the executives responsible for this program at Fleming lived in the Chicago area. He wanted to stay also. So we set up an office in Northbrook. And I worked out of that office for a little over a year before it closed. It was a cost-cutting measure to close that and take all the purchasing into their corporate office in Texas. And it was something that I always knew might happen, and it made sense. Fleming had actually moved its entire company, and this is significant later when you find out why people inside a large organization do what they do. Everybody from Fleming moved from the previous corporate headquarters in Oklahoma City to Louisville, Texas. The whole company moved. They leased a huge warehouse space. It was like an industrial park, and it became the corporate office for Fleming. But everybody working for Fleming in 2001, 2002, until they went bankrupt in 2003, were located in Louisville, Texas, and nobody was there originally. That's significant when you think of the pressure on people to produce numbers and why there were accounting lapses in the end that led to the downfall. The first meeting I had with Mark Hansen, and you know, talk about why you would make a change, going from a little privately traded company, getting flown on a corporate jet down to have dinner with the CEO, and he's got this vision for a new store. And I asked him how he was going to fund this. I knew Fleming had a lot of debt, over $1 billion in debt, even though they're a large company. I said, how are you going to finance these new stores? He said, well, we've got $450 million in free cash flow. There's plenty of cash out there to open stores. I was very naive. I should have understood that anybody that's dipping into their free cash flow to fund new projects, not the best place to find the money. But there was a lot of money out there. And we did get 17 stores open. And again, they were going on well enough that they thought my services were better used managing all the private label procurement for Fleming. The reason for that is that they said, well, how are these guys with 17 stores buying a lot of items for a lower cost than what Fleming, this $15 billion wholesaler, is buying for? How can this little group get lower cost than the large group? And it's all comes down to that culture and business practices. I had learned at Aldi that you make your deal, you negotiate for the lowest everyday price you can. There's no funny money involved with that negotiation. Just get down to the lowest everyday cost you can. At Fleming, everything was funny money. You'd have an elevated list cost that you were charged for something. There would be all sorts of allowances that were negotiated below that list cost, and that's where they got in trouble. This gap between what the list cost was and what the true cost was and what it needed to be. It took a lot of energy for the buyers to negotiate that. It was a whole different mindset for them. So they said, look, the guys that are running Yes Less know how to handle private label. We're going to let them be vice presidents of private label for all of Fleming, and they'll buy it for the whole wholesaler. So when I went down there, that's what my new position was, as vice president of private label. It was 2 weeks until as I'm sitting in meetings, these guys were not good business people. That gap between a list cost and what you actually pay got exaggerated, and these guys were masters at manipulating that so that a company could report earnings when it bought product instead of when it sold product. And that really is what led to Fleming's downfall. Here's the Wall Street Journal article from September 5th. This is the last time it's September 5th, 2002. It explains exactly what was going on with the vendors. It's a very accurate article because the main source was another vice president that worked several offices down from me. He left the company. He couldn't stomach it any longer. And he had an axe to grind, and a friend at the Wall Street Journal. And the information is 100% accurate. I have a lot of respect for the Wall Street Journal. It's a front page article, and it was 100% correct. The folks at Fleming and the culture there was that if you needed money to hit your earnings, you could always go back and deduct from the vendors. That was the mindset. Make a deduction. And from an accounting side, we had a controller in our group, and he would always sit there and shake his head and say, no, we can't do this, we can't do this. And somehow at the end of the day, you finally rework the language until it gets done and it gets put. So a few months after I got down there, Fleming signed up their biggest retail group ever. It was Kmart. Fleming supplied them all the groceries and consumables in their stores, which is paper products, health and beauty care, soaps, detergents, things like that. A significant piece of business, about $3.5 billion, as I recall. We negotiated for it. Had an internal project that nobody could talk about. They called it Project Blue, which everybody figured out as soon as you said the name from the old blue light specials. But they negotiated for that business, gave Kmart an incredible deal to supply them with all of those grocery products and consumables. My goal in that private label piece was now to make a program work with suppliers that could supply Kmart, could supply Fleming, and could supply the Fleming-owned retail group. All three, and the Fleming private label group. So we had to make everybody happy. Ice cream was a big deal. Ice cream is the largest frozen category. There's more dollar sales in ice cream than anything else in the frozen case at the grocery store. Well, our private label program was a mishmash. We had suppliers in different parts of the country, different labels all over the place. We needed to organize it. Go to one supplier who could handle the business everywhere, negotiate the best deal, and make it work for everybody. What happened was Kim's Miracle had the plan. They have enough plants in different spots in the nation that could supply everybody. They had great quality product, and they had a competitive cost. So we negotiated a deal. They also had incentive money. They had $3 million. They gave Kmart $1 million to make the change. You have to say no to your other suppliers and buy from them. They gave Fleming Retail Group $1 million because now Kim's/Marigold is the supplier for the Fleming Retail Group. And they gave $1 million to Fleming Corporate or their private label group. So we had $3 million out there. Now what happened was in the fourth quarter of 2002, our CEO was out there talking to Wall Street saying, here's what our earnings are going to be, 56 cents a share, or whatever. That's a rough number. This is what we're going to earn this quarter. And he trots back into his executive suite and gets a handful of guys around him and says, now, look at our plan. What are we really going to earn? And they find it's maybe 20 cents a share. So there's a gap. How do you make up 30 cents a share in a very short period of time and hit the projection that you've given Wall Street. If you don't hit it, that your stock's going to tank, and people lose confidence in your company. Your credit can be downgraded. There's all sorts of negative things that happen when you don't hit your numbers. My response was always, well, let's be more careful with the numbers we give everybody. Nobody wanted to hear that. Our CEO was trying to turn this value company into a growth company, and he sent very aggressive numbers to Wall Street. So we had a gap. And what happens is Phil Murphy would come back from that meeting and say, okay, here's our part of what we have to fill. We need $30 million. Our group had to generate $30 million. So he goes, okay, there's about 12 of us in roles comparable to mine. What are all the deals you've got out there? And one of them that I put up on the list was, I said, well, we have this $3 million from Kemp's Marigold. It's a deal we've been working on for almost a year. The money's right here. It's cash, and the money's there. But the question is, how do you account for that? If that's an incentive for a program that's happening now and in the future, how do you book that as income? And can you? The answer I was told 3 times was no. You can't book it as income. You have to take it as future earnings because it's for a program going forward. So Phil Murphy said, well, call it a rebate. Call it a rebate for business we don't invest. We did a little business with Kemp's Marigold already. Not everywhere, but we had done some business with them. He said, just call it a rebate and have them sign a paper telling you it's a rebate. I'm like, well, that hasn't come up before. I don't really know if that's right to do that. So I talked to the sales guy that I dealt with. Is this something we can do? His CFO got back to him and said, no, we really shouldn't do that. And after going back and forth, Phil Murphy desperately needing that money because he's got to walk back into the CEO and say, we've got you covered. We've got $30 million here that we can book as income and hit your earnings number. And at the end of the day, after going back and forth 3 or 4 times with our CFO, whose name is also on that, who is it, Shapiro? Mark Shapiro? Is he on top there?
Yeah.
Yeah, Mark Shapiro was the chief financial officer. At the end of the day, I couldn't get it done. I said, look, everybody's telling me no. And I went to Phil and said, no, Phil, they're saying it can't be done. The money's there, but we can't book it now. So I'm done. And he said, just tell Shapiro to talk to Miracles about it. I said, oh, okay. I said, they know something I don't find. So I had Mark Shapiro talk to Kemp's Marigold, their chief financial officer. The next thing I know, there's a letter in front of me signed by the CEO of Kemp's Marigold saying that this was some sort of rebate or something. And, at the same time, their sales guy signed the agreement, formal agreement, contract, that they were going to be our private label supplier. So, okay. I guess they knew something I didn't. Again, I was a year and a half, maybe 2 years out of working for a publicly traded company and never had to get involved with anything like that before. We'd always just negotiated and moved forward. And there was never any incentive money associated with any of the deals that I'd done before, but now there was. And this is the way they did business. I mean, this was normal, and it still goes on today. Super Value is the major wholesaler that does business this way, and CNS Wholesale, there are others. I don't mean, I'm sure most of what they do is above board, but there's potential for danger. I signed that agreement, and we booked that money, and they hit their earnings that year. And the sad part of it is those earnings are also linked to the incentive. I mean, the bonuses that all the executives got were only available if you hit a certain earnings number. So again, more incentive for people in a big organization to do whatever it takes to hit the number. And your options also. And options as well. I mean, because it's all linked to the stock price. So the factors that make it so tough, it's really like a boiler room at some point. And really, when Phil Murphy came down, he got the 12 people that controlled all the negotiations and locked us in a room a quarter the size of this one and said, we can't go out till we figure out how we're going to generate $30 million. I shouldn't say he locked it, but clearly if you left the room, you left your job. And after having just relocated your family, and again, everybody in the room had relocated their families to this area because the whole company moved. And not only that, but when you move, Fleming was very generous with their relocation expenses. They had this executive relocation program. If you couldn't sell your house, this company would buy it for you and then sell it for whatever they could and take the loss. If you leave the company within a certain period of time, you had to reimburse them those relocation expenses, tens of thousands of dollars that I'd have to pay out of my pocket if I left. The HR person said, you know, how are you perceived as a buying group out there in the world with Procter & Gamble, these other vendors that you deal with, and with some of your contemporaries, your other person groups? How is the Fleming group perceived? And my stand was that we're pirates. I mean, you know, we don't, you know, a lot of fun to hang around, but you know, the guys around me would cut your throat at the end of the day. One of the guys next to me came up with this brilliant idea that, well, there's going to be shared savings now. Now that the vendors don't have to go to Troy, Michigan to call on Kmart and Louisville, Texas to call on us, they're going to save money. But we're going to be easier to deal with. The volume's going to be greater. They're going to save money. So they sent out a letter that said, congratulations. You know, you're now selling to and working with this new larger company, larger purchasing organization. It's only going to cost you 3% of your total sales for the year. That's millions and millions of dollars, and hope for the best. We put enormous pressure on them. You know, we did over $1 billion in business with Kraft alone. One of the companies obviously got fined is Kraft. I really feel sorry for the guy named Adams. You can read about him in the article. He was under enormous pressure because of the volume of business that they did with Fleming. Fleming is a very important customer to Kraft, $1 billion in sales. And, you know, if it meant signing a letter that, you know, $7 million or $10 million would get funneled to Fleming somehow over a couple of years, he signed it. There was still hope. I mean, when Kmart business came on, if everything happened the way the CEO wanted it, it could have worked. I mean, look at what Sears did with Kmart. That worked when they just got together and made it work. But for us, it didn't. It just did not work. I could see it going bad. I was tired of being the company was using my credibility that I had worked hard for over 16 years with Aldi and doing clean business. They spent my credibility dealing with vendors now, where I would sit with somebody face to face at a desk and I couldn't tell them that everything was going to be handled. I couldn't tell them that their bills were going to be paid, that those deductions were going to be repaid. My word didn't mean anything to them anymore. And I wouldn't. I would just tell them, listen, look, you know, we're all in trouble. You know, this is not going to work. You know, if you want to get those paid back, I don't think you're going to. What happens then is if they still want to do business, and that's a big if, it'll be at a higher cost. You know, whatever you're taking from them, they're going to add back to the top line cost because they have to make money at the end of the day. And it's a really vicious cycle that, as you know, elevates the cost, makes Fleming uncompetitive in the marketplace. And at the end of the day, that $450 million in cash flow that Mark Hansen was so proud of, it went away because these vendors said, we can't handle the deductions anymore. It's not working. We have to put you on cash in advance. And that's a death knell for a company. As soon as you start having to pay for product before you receive it, your whole cash flow goes away. One of the yellow flags that went up early for me when I was running those 17 stores at Yes Labs, the invoices went through the Fleming accounting system. They had a computer program that figured out how long they could stretch each vendor. I had no idea, couldn't believe it. And it was really based on feedback. Well, how many days is it before this vendor will call me and ask for his money? Okay, it's due in 30 days, but I haven't paid in 45. When do I get that call from them? And they recorded it. Each time they would record, okay, so this person doesn't care until 45 days. So they would just never pay until 45 days. If you weren't sitting on top of them, things wouldn't get paid. So yeah, they definitely stretched that as far as they could. But you think about that, a $15 billion company, that's $41 million a day in business that you're doing. And that's literally what crushed them in the end. When you can't buy products because you need cash in advance and your customers are clamoring for it, you're out of business. And Fleming literally went out of business because of that.
Yeah, so they could have been profitable.
Absolutely, and they were for many years. I mean, Fleming's was a 100-year-old company that had grown through acquisition and been successful up until that lawsuit with David's, quite frankly. I mean, they hadn't made money for a few years, but when Hansen was there, they reported their first quarterly profit in 4 or 5 years. And yes, they could have made money the right way. But his vision was to not just have a value stock, not just to be one that languished out there and just kind of safe and comfortable. He wanted growth. He had come from PetSmart, Sam's, fast-growing companies, and as we looked at his history, he kind of did visit those companies too, unfortunately. And he never learned his lesson. I think he's learned it now. I was very surprised. I was surprised that people beyond Jim Thatcher, Al Abood, and Phil Murphy weren't charged. I will say that Al Abood, who was right next to me, another vice president, the whole reason he was there was because he was better at taking that money than anybody I ever met. He actually worked for Kmart, did it there, got in trouble at Kmart too. And I was astonished one day when I came in and he was in the office next to me. I'm like, hey, why are you here? And Phil Murphy had hired him. He apparently did such a good job taking money at Kmart that Phil wanted him on our team. And that was another red flag for me to get out of there as quick as I could. Yeah, I wish I would have stood up on the CEO's desk and said, look, this is not right. It's not right what you're doing to your own people, number one, putting me in a position where I have to, again, spend my credibility to try to save face with vendors. And for the vendors who are our partners in business, we can't be in business without them, for sure. We're destroying those relationships, and it's not right. I can give you one specific example. It's one of the companies that got fined. There's Kim's, Marigold, Adair. They got fined. The CEO got fined. Their chief financial officer got fined. Personally, they got fined as well as the company, hundreds of thousands of dollars in fines. That was a deal I did. I was very upset about that. My resignation letter to Phil, I worded it carefully. I was an English major in college before I started working in the grocery business. And one of the things we use when we analyze poetry, we talk about the gap between appearance and reality when somebody wrote a poem. And to me, that's what I saw Fleming was this huge gap between the appearance that the CEO put out there and the reality of how the business was run every day. And I told Phil that I could no longer willingly suspend my disbelief in the way the company was being run. And that was true. I said, because you would sit around and look at each other and see the way you're doing business, just shake your head and say, I can't believe this, I can't believe it. And you have to willingly suspend that disbelief to operate in that environment, in that culture. Couldn't do that any longer. It's too obvious. I mean, the facts were too obvious. The business model was not working, at least not the way the CEO was describing it to Wall Street, that we're this big growth vehicle, we're going to be profitable. It was not. We were scraping for every penny. Another startup opportunity in New York became available. Once again, we could set our corporate buying office here in Chicago. So we got the team that put the Eslet stores, several of us back together to open another chain of stores in the Northeast. And I was excited about that. Negotiated a fair salary, no bonuses, no stock options, it was a private company, it's one guy. The document that none of you ever want to see again and ever want to see your name on is this, it's my subpoena from the SEC to testify. So pass that around and make sure you never see one again. But the bottom line is that it's very easy to testify in front of the SEC. You tell them everything that happened, exactly why it happened, don't leave out any details, and it is what it is. Unfortunately, a lot of my testimony led to huge fines for the guy that worked right next door to me. His name's Al Abood. Here's the SEC exchange, what they charged each of those guys with. But I reported to Phil. Al Abood was a vice president, just like I was. He worked right next to me. If you don't live it and feel it, and you would never know. You can read about it, but it overtakes your whole being at some point when you're right in the middle of all of that, and you see it kind of crashing down. So, like I said, at the end, it can make you stronger. I certainly learned a lot. They also wanted to know a lot about the CEO. The one thing I'm truly amazed about is that Mark Hansen, CEO, he hasn't been charged with anything. But it's very difficult, you know, and I have sympathy for the SEC as they go after like the Ken Lays of the world, or Bernie Ebbers from WorldCom, or it's very difficult because these CEOs never send an email. They have assistants and they do everything in meetings and it's all verbal. It's never taped, but the direction is completely clear. They walk into the meeting, they come out with their marching orders. Each senior person has to contribute a certain amount of money so they can hit the earnings that he's talking to Wall Street about. None of that is in writing, other than the notes that the guys take who were in the meeting. So I had to say, yes, when Phil came out at his meeting with Mark Hansen, this is what he came back to us with. We need to, you know, make $30 million here to hit the number. What you really judge on is what you do and not what you say, which is right in some ways, but for a CEO who never does anything himself, he didn't sign any documents except Sarbanes-Oxley. When Sarbanes-Oxley came out, we were all, and it's an interesting sidelight, we were like, is he gonna sign it? Is he gonna sign it and say, yes, I believe all this information is 100% accurate? He did. He did sign it. And I always thought that that would come back to haunt him, to say that to the best of my knowledge, all these numbers are accurate, everything's justified, when he knew in his heart anyway, that it wasn't accurate, most of it was manufactured. It's so interesting when I used to hear Ken Lay, who would just insist on his innocence, you know, and just think, you know, what we did wasn't wrong. Yes, we did all of that. Yes, we created these subsidiaries and put the debt all over there, but that wasn't wrong. It wasn't wrong. It's like they convinced themselves that what they're doing is right. When I listen to some and read some of the quotes that Mark gave to Wall Street, that, you know, the deductions that we have with vendors aren't out of line. It's in the Wall Street Journal article. It's not out of line with what the industry standards are. It's a certain percentage of sales. It's always like that with every wholesaler. They convince themselves that what they're doing is right, that it's okay, and that this is the way of doing business. There's just some sort of a mental illness almost when it comes to that. The CEOs get it sometimes. It was frightening to watch. I walked away from big bonuses just doing what I did. The other guys that stayed, even a few months after I was there, I was 2 months away, I think, from like a full year's bonus, which for them, again, was too generous, almost 80% of the salary. I didn't want it. Who would want that? So I wasn't going to stay long. And I would have continued to do what I was supposed to do, which was to put together the best deals for the company that I could. How they were accounted for, I did kind of mentally separate myself from that. I had to. I mean, all I could do is what I knew was right every day. Negotiate for the best quality products at the lowest price. Simple. That's what I'm there for. How you want to account for everything else, I just kind of washed my hands up and said, take it from there and go. That's kind of the mode I was in right at the time I left, and I would have found something else at some point. That was not sustainable. The guy that had worked for Fleming for probably 27 years, was a merchandise manager there, and he stayed right till the end. And you know, it was horrible for him and his family, knowing that this 27-year career he had, and probably his retirement, you know, account with the company was all in jeopardy at that point. I mean, his wife actually had some mental problems, and she committed suicide the day they went bankrupt. It was really, really horrible. There are personal tragedies involved when things like this go on. It might have worked. If Fleming had ever purchased Kmart the way Sears just did, you know, maybe their stock would be $100 like Kmart's and Sears is right now. But that didn't happen.
Oh. All right, let's see here. Excuse me. Oh, yeah. So that I think he did a very good job of kind of explaining how this stuff kind of happens, and that, you know, again, a lot of times, you know, these are the people that, you know, people are involved in that. It can be a lot of times your best employees are the ones that are more likely to end up doing something like And Mark Henson was this big name in business, and working for him was a real, came from PetSmart and Sam's Club. The idea was, this is a great place to work, but anyway, let's get rid of that. Oh, now there's nothing on my screen. Okay, so going through this, most of the stuff is pretty straightforward. For Aldi, second company was Fleming. And you say, I never heard of Fleming. It's because they went bankrupt. And by the way, one of the weird things is one of the really interesting parts about a couple interesting parts about that company is they were profitable. They weren't as profitable as they showed that they were, but they were actually profitable. And not only that, they went bankrupt in months. And really, when things started to unravel, it was literally a couple months when they ran out of cash, couldn't pay their employees, couldn't pay the vendors, and were out of business. A 100-year-old company, literally in a couple months, collapsed. It wasn't like it happened over 5 years or something like that. Literally in 2 months, they went from, having some cash for operations to nothing and being bankrupt.
Is the CEO still alive today?
I'm pretty sure he is. Yeah, he went on to other stuff. Yeah. Well, another, it's very difficult to. There's a couple things that are difficult in fraud that to prove. And one thing is, like you said, there was no paper trail. There's no notes. There's no email.
Yeah, he was really smart about it.
And two, it's also very hard to prove intent. If you're going to prosecute somebody for fraud, you have to prove that they had the intent of deceiving people. It can't be an error. It can't be, a mistake. No one goes. You can't convict someone of fraud if they make a clerical error. They, write down $6 million instead of $6 for a stapler. You have to show intent, and that is very difficult. And remember, in a criminal court, it has to be proved beyond a reasonable doubt. If you get somebody to convict somebody of fraud, it really takes quite a bit to do that. The companies were different. One was public, one was private. Aldi was private. And he left Audi's because he had a better future, basically. The idea was that he wasn't going to be able to move up. He wasn't going to be able to get.
Yeah, no growth.
Right. His supervisor was the same age as he is. And his position, I think, was vice president of
Private label.
Yeah. This whole label looks funny to me.
No, that's correct.
And what pressure caused fraud? This is another very curious thing. CEO's estimate to Wall Street. Another pretty crazy thing about this, the thing that got this whole thing in motion was, I guess 2 words probably, that one, an estimate given by one person sunk a 100-year-old company with 15 billion, and hundreds of thousands of employees and everything else went under. I mean, and it all came from that fourth quarter 2002 estimate that he gave Wall Street, which, by the way, is one of those things that when I kind of went into business, kind of became an accounting and finance person, just amazed me, was that companies were allowed to give estimates to Wall Street. They give estimates and forecasts. Sometimes they have complete forecasted financial statements. And there's actually auditing. You can actually do audits on forecasted financial statements. I know that sounds completely insane because you're doing an audit on something that hasn't occurred yet. But you look at how they made up those forecasts. It's something that if I were running things, they would be stopped. You would not have any estimates. You want to know how a company's doing? Wait until they put out their report. Wait until they put out their annual report or their quarterly report or whatever. But they have this thing, those estimates, and this isn't the only company that has run into that, where someone says something crazy, and all of a sudden it triggers a fraud. And by the way, that's another thing that CEO can say is, well, look, I get information from my people, and I didn't know what they were doing. They were doing these crazy things, but that wasn't me. That was them. Okay, and Anthony they tried to get the rebate. And send the money. A rebate. And that was basically that was his part of it, was that he was supposed to try to get this thing changed the rebate. He wasn't able to do it. And I don't know if you guys picked up on this, but he also talked about being an English major. He really didn't know much about the actual nuts and bolts of business. You can kind of get that, at least when he entered the company. He certainly didn't. He did his deals and all that kind of stuff, and how they accounted for it. Was a private company. They worked for Aldi. He didn't know how they did it. Didn't probably care too much how they accounted for things. It's a private company. They can do however they want. So, he was fairly naive about how companies actually operated, especially publicly traded companies. And again, he's an English major. I don't think he ever had a business class, any business class. I mean, forget about anything in accounting or finance or anything. When they go bankrupt, they ran out of cash. They ran out of cash. The suppliers refused to sell to them. They'd have to pay cash in advance. Anthony was actually not charged. And by the way, I cut quite a bit out of here. But Anthony was not charged with the SEC. And why? He failed to get the rebate letter signed. I mean, talk about, and he probably thought it was a failure at the time, but talk about a lucky break. It's reasonable that if he had asked them to sign the letter and they did, he may have been fined and, had to pay tens of thousands of dollars and all kinds of stuff. But because he didn't, he became a witness for the Securities Exchange Commission. And it's kind of funny because he told him, look, I tried to get it signed. I was told to get it signed. I tried to get it signed. I couldn't do it. And then they pulled out all these emails. They had all these emails from him to his boss and said, yeah, well, we found out this, you you couldn't get it done. So, you didn't have a hand in it. But dumb luck to some extent that he wasn't charged in it. And he talked about it. They had to cut some of it out to make it reasonable. But one of the things he talked about is that the auditors came in and he said, I wanted to talk to him. I wanted to talk to the auditors and say, do you guys really understand what's going on here? Do you really understand what happens? What's happened here? And he said, I didn't do it because no one asked me. And that's something that as auditors, it sounds strange, but a lot of times people will do that. They'll sit there silently and not say anything. But if you ask them, do you know of any fraud? And you just throw that out for every, anyone you ask for, do you know of any fraud? It's surprising how many people will sit there silently, not tell you anything. But if you ask them directly, they don't lie. A lot of times they'll say, yeah, there's fraud going on. Well, for one thing, this incentive money thing, they'll just spill it a lot of times if you ask them directly. And Anthony was one of those people. He said, well, I was hoping that they would talk to us, the auditors, but they just kind of, did talk to other people and all that kind of stuff. So, what you get from that as an auditor is, okay, whenever I talk to people, throw that in as a question at the end. Do you know of any fraud? And again, a lot of times, not a lot of times, but sometimes anyways, you'll get people that will tell you. Something profitable? Yes.
Didn't correct me if I'm wrong, didn't the CFO of Marigold end up signing the rebate though?
Yeah.
Okay. But it wasn't Anthony who was in with it. I was kind of confused about that part. So
Anthony was, he was working with the vendor, their representative, and so he said to the vendor, can we get this called a rebate? And the vendor said, I don't know. And he went and talked to the CFO and said, no, we can't do it. So he didn't actually directly talk to the CFO of Marigold. So apparently Marigold, though, went all the way up the ladder, and they said, okay, it's a rebate. Fine, you want to call it a rebate, whatever. So they end up getting charged for it. People in Marigold.
Right. Okay, now I get it. Thank you.
Yeah, and it was because the CFO got involved and actively got it, and the CFO was one of the people that was probably I can't remember exactly what the fines were, but he was pretty heavily fined. By him. And again, one of the things about things like this with the SEC and that is that they can go after you individually. They don't have to go after the company. The SEC does not have to go, they can go after individuals. And that's one thing that some people are somewhat surprised at. They think, oh, well, the company's going to protect. The SEC can go after individuals. But the company says they'll protect me. The company, first of all, the company's bankrupt, so good luck having them protect you. So anyway, so this was a very what am I going to do here?
He said he went back to LD, right? Did he?
He didn't go back to Aldi. He went back to a company that supplied Aldi.
Oh.
What am I doing here? I don't know what I'm doing here. He went to a company that actually supplied stuff to Aldi, and he's gone through a few different iterations. He's actually done pretty well. But here's the thing too. He talked about this later on. That people would ask him, well, did you know? You worked at Fleming. Did you know what was going on? Yeah. Talk about an awkward thing to have to say to someone who's a potential employer or something. But what'd you do about it?
He's extremely lucky that people were still willing to hire him. Based on what went through with that company.
Yeah, and some of the people that were charged, most of the people just took a deal. I think there was one initially, and I think one came out later where they tried to go back on the deal. Because I want to say that some of them even got were told that they couldn't work as in finance anymore. Basically, they couldn't. But anyway, so a couple of them fought it, and I'm not exactly sure how that came out. But I do know that even after Anthony left, he got a few more things from the SEC asking him questions about stuff. But yeah. So there were, I believe there were some in there that were basically not allowed. I don't know if it's some period of time or whatever, that they couldn't do anything with financial reporting, or at least for publicly traded companies. But yeah, but go ahead.
I was just gonna say this reminded me of another case that I studied before. I don't know if you know this guy, Mickey Moniz with Farmore.
Yes.
Yeah, kind of reminded me of that.
Yeah, here's another weird thing. Farmore was a huge, very fast-growing discount company their whole thing was that they would undercut Walmart on everything.
Yeah, that was crazy. No one could believe it.
Well, and one of the ways they did it, I don't know if you ever shopped at one of those, but I don't think they've been around for years. But they used to have virtually no control over their inventory. They would have things stamped on the inventory. They had price tags actually stamped on the inventory. So when you went to the shelf, if you're looking for soap or something, you'd look around the shelf and they would, oh, here's one for $1.19. Oh, here's one for $1.10. And you bring it, and they would ring up whatever was stamped on it. They had no control. By eliminating all those controls, that eliminates a lot of the costs. If you limit the controls, and they probably at least initially were okay. We limit the controls. We can do this more cheaply than anybody. It didn't really work out that after a while. It kind of imploded that they had, and that really before Enron, that was like the big case, Farmore. But Farmore was they had a lot of stores opened up all over the place, and one of the kind of funny things too is that when you hear Anthony talking about Sears and Walmart getting together and how well that worked out, and I've always been tempted to pull that out because it's not really true anymore. It hasn't been true for a long time, but the funny thing is the whole retail world was pretty much divvied up between Sears and Kmart. Sears and Kmart divvied up the world like in the 70s and the 80s. Sears was kind of like Target, but bigger. And Kmart was kind of the discount place. And Walmart was this weird company that every now and then someone from down south would talk about. No one really knew anything about them. It was kind of like a Kmart knockoff was Walmart. But Kmart and Walmart were the two big companies. And Kmart and Sears are the two big companies. And Sears was so big that they decided at some point they couldn't make any more money out of retail. That they were making so much money on retail that they had so much of the market that putting more money into retail was not going to do it. They started the Discover card. The Discover card came out of the Sears company. Sears made the Discover card, and the only two credit cards back then were in kind of are MasterCard and Visa. And the only company that was big enough and had enough money and everything else to put something like that through was Sears. Sears started a credit card where no one else could because they were so powerful. And now that's pretty much the only thing that's going to be left. They sold it off years ago, the Discover card. But the Discover card is going to be probably the only thing that's left of Sears. But it was because they made so much money that it was like impossible for them to make any more money in retail. So I don't know. Yeah. It's funny how things change. And when I was going through business school, Sears was always held up as the gold standard of how you run a company. And nowadays, there's many people that have grown up without ever even seeing a Sears. So anyway, yeah, but so when that, they talk about this Sears and Kmart stuff in there, like I say, I've always been tempted to pull it out because I think, most people aren't going to realize why that was such a big thing. But, those are the two. It would be like sort of like, years later if Target and Walmart merged. That's what it was like for Sears and Kmart to merge. That was for people from that era, that's kind of what that was.
Did you know that the former CEO of Fleming, he's the board of director on Amazon? He sits on the board of directors for Amazon now.
Anson, I don't doubt it a bit. He was a big name. He still is. Like I say, he came from Sam's Club. He came from PetSmart, and those were little places that he left. They boomed. It's not unusual at all that he's up there. And again, he is
surprised that Amazon actually won. Sorry, go ahead.
Yeah. Well, here's the thing. He was never charged. He was never charged from, for signing the Sarbanes-Oxley letter, or for any of the stuff that went on for the financial statements.
To be honest, it's not overly surprising because it's to the fact of it just goes back to, bigger corporations, all they really care about is making money. And so if they're able to pull that from, and see oh, he didn't get, charged, they're like, why not just add him to our staff? So I'm not really surprised by that.
Yeah. Well, and again, in his name does, it did carry, and it carried other, because of his other successes, carried him out of the whole Fleming disaster. He was only there 3 years. I mean, it was, or maybe it was 4, but yeah. So it's a very unusual thing. I'll tell you something else that is unusual, and actually, Anthony kind of talked about it a little bit when he said about how these CEOs get this idea that, well, no, what we did was right, And I remember Fasto, the guy from Enron, who was a controller, and he was sent away for a year. I think he took a big sentence so that his wife didn't have to go to prison because they had young kids or something. But anyway, they had an interview with him, and he's in jail. He's in jail for 9 years or whatever. It's a federal prison. He's no parole or anything like that. He's going to sit in there for 9 years. And they're asking him about this. Well, you did this. He said, yeah. He said, I'm not a bad guy. I'm the hero. Everyone wants profits. Wall Street wants profits. Our board of directors wants profits. All the management wants profits. Everyone wants profits. I gave them profits. I gave them exactly what they wanted. I'm not the bad guy. I'm the hero. I'm the guy that did it for them. The idea that it broke the law and all that had nothing to do with it. In his mind, he was doing exactly what everyone wanted him to do, what he should have been doing. He did exactly, but they get this whole thing that, this kind of skewed reality of, what's going on, and that this can't possibly be wrong, to do this. Everybody wants it. How can that be wrong? That sort of thing. It's a very,
I was just wondering, so I'm assuming business ethics classes were not a big thing back in the day. That's what it's...
Well, and actually, I'll tell you something funny. I always used to make fun of ethics classes because I would say, well, an ethics class, if someone is, wants to do something, an ethics class isn't going to do anything. I have really changed my tune on that because, and Anthony, I probably should have left. There's some stuff I probably should have left in here. One of the things he talked about was ethics classes. He said, it's not so much that it's going to change somebody who's, predisposed to do something bad. He said it's so people recognize when they are involved with something that isn't right. And Anthony recognized it right away, but he really didn't do anything, about it. I mean, it was, So, and this is before, whistleblowing and all that became, the commonplace, that whistleblower programs and all that, which are now required by public trade companies. So yeah, and he said, ethics classes, he said, you got to have them. He said, because, and if you think about it, and like I was talking about before with this thing, that, mathematically, it's impossible to get, I don't know, I think 12 people or something like that were charged with Fleming. It's impossible to get 12 people mathematically who are bad people together. So what happens is, the pressure turns people into that. And so, he said it's very important that people realize when they're in a position that is unethical or even illegal, that they recognize that. And that's, he said, the most important thing is to recognize that this isn't right, and and to do something about it, and what you do after it, and that sort of thing. So but ethics classes, it was one of those things, like when they first came out, I thought they were a complete joke, but they're not when you think about how frauds happen and other things that happen, that it really is the environment that will change people. It isn't merely that this person's a bad apple and they're going to do bad things. That's not usually the way it works out. It usually works out that there's other things, especially for large frauds that are on financial statements and things like that. So anyway, it was actually very surprising to hear my brother-in-law talking. He does pretty well. He's pretty up there. And for those of you that are sports people, he was a goalie in soccer. He's a soccer goalie at I think it was Rockford College. And for a while, I don't know, he probably still doesn't have it. For a while, he had the most periods of not being scored upon or something. He's a big guy. He's like 6'4" or something. And he was a goalie. So he's a goalie slash English major, and ends up in this with these pirates down in Texas. So anyway, I think I will call it a day there. Next week, I'm going to give you guys the review for the. Oh, any other questions or anything about it? Any comments on it? Okay. So next week we'll do a review of the. We'll keep going on our chapter 3, but I'll give you a review of the sampling. It's going to be the sampling test, and then I'll send out the sampling test. And so next week is week 12. I think week 13.
Spring break.
Yeah, we're off. So that'll give you a couple of weeks to work on the sampling test, or to not work on it for a couple of weeks. And that'll be a good kind of a cutoff point for that. Okay. Any questions?
We don't have a final. We'll just have like a chapter test, right?
No, it's not a comprehensive final or anything like that.
Okay.
And I do have the multiple choice. I could add multiple choice question bonus points onto the exams, and I do have those. They're not in front of me, but I do have them. I was going to hold them up, but I'll hold up these little guys again. How about that one? There we go. No, but the extra credit points will be added into the exams also.
Okay, thank you.
Okay. All right. Have a good weekend and stay safe.
Thank you. Have a good one.
Thank you.
Yeah.
Have a good night.